Hello, everyone, and welcome to this episode of CML Podcast. Today, Jason and I discuss the role of random processes in understanding both economic crises and financial randomness and why it matters for your portfolio. We also explore something called a fraud swap, which is a tool to manage fraud clustering in markets, but also discuss a possible adaptation to the cryptocurrency ecosystem for securing those assets and enhancing accountability. The discussion of the fraud swap is based on a white paper I published over a decade ago and is included in the description of the video below. This podcast was originally recorded on January 24th, 2025.
All right, let's start with something that's at the heart of today's chat. Stochastic processes. What are they and why should we care? We hear terms like singularly stochastic and doubly stochastic thrown around, but what do they actually mean in practical terms?
Great question. Basically, a stochastic process is just randomness playing out. A singular one? That's path-independent randomness, like flipping a coin. Each flip's totally separate from the last. Every flip has a 50% chance of being heads or tails, regardless of what happened before. The outcome doesn't build on itself. It's well-behaved randomness.
Right, so no memory. Each outcome's its own thing. Nothing carrying over from before, right?
Exactly. If you flip a coin and get heads, it has nothing to do with whether or not you had heads or tails on the prior toss.
Okay, but that's not where we're headed today. Ophir, why don't you break down why randomness matters in finance? And yeah, let's even connect it to fraud and Bitcoin.
All right, let's get into it. Here's where it gets interesting. So, randomness? Yeah, we all know what that is, right? It's just things happening without a clear pattern.
Right, like the stuff that feels totally unpredictable.
Okay, now, when we think about randomness, most of us picture stuff like flipping a coin or rolling dice. That's what we were taught in school. Simple, clean randomness. Flip a coin. Boom. 50% chance of heads, 50% tails. Roll a single die, 1 in 6 for any number. It's random, but it's also super well behaved. We know the odds, we know what to expect. No surprises.
But then things get interesting because not everything in life is as well behaved as a coin toss.
That's right. Some things like earthquakes or credit crises have this really sneaky characteristic. Let me explain. Imagine this. You're living in California and someone tells you there's a 1 in 100 chance of an earthquake today. All right? Cool? You've got earthquake insurance, you know to duck and cover, and you can deal with that. But here's the kicker. If an earthquake does happen today, the odds of another one tomorrow aren't still 1 in 100. Nope. They shoot up. Let's say it jumps to 1 in 10. And if there's another one tomorrow, maybe it's 1 in 2 the day after. This isn't just random anymore. It's what we call self-exciting. One event increases the odds of the next one. That's how earthquakes work.
So these doubly stochastic processes, they're path dependent, which is a totally different beast. So that's where we get into systems that don't return to baseline right away. They escalate like shock waves expanding outward. But why does this matter outside of geology?
Well, because the same principle applies to financial markets. Let's take credit contagion, for example. One company defaults. Suddenly, every lender linked to them feels pressure.
Right, so it's not just about one company. It's everyone they're connected to that starts feeling the heat.
Exactly. Then another domino falls. Next thing you know, it's an industry-wide meltdown, a classic clustering of defaults. It's been mathematically modeled as, you guessed it, a Hawk's process.
So this isn't just random, like a one-off event. It's all connected, and it spreads.
What's great about the Hawk's process is that it doesn't just measure random shocks, it shows how each one cranks up the odds of another happening. Think back to the financial crises triggered by geopolitics or, more recently, COVID.
Yeah, those shocks weren't happening in isolation. They just kept triggering more problems.
Exactly. Each economic shock, monetary, supply chain, inflation, they all triggered what's essentially a shock cluster. These weren't isolated events. They were interconnected ripples, growing into waves. And that's kinda where the brilliance of this framework lies. It lets us model the interdependencies even if they're chaotic.
It's kind of unsettling, isn't it? Because this suggests that stability isn't as stable as we think. Yes, if one event pushes the system over its tipping point, everything can spiral. But does it ever calm down? Or does the system just keep spiraling it?
That's the beauty of it. The feedback loop has its limits. After a time, that heightened probability of another event decays exponentially. It cools off. So a single shock doesn't usually wreck the system forever, but during those risky cluster phases, it's dicey. Historically, we've seen this. like the stagflation era of the 70s. Things eventually returned to normal, but not without some serious pain along the way.
And we're still kind of walking through that dicey phase, aren't we? Post-COVID, it feels like we're in these same feedback loops now, even though the shocks have started to mutate into new forms. It started with fiscal pressure, which caused inflationary pressure, then monetary pressure in response to that inflationary pressure, and then it spiraled further into geopolitical pressure.
Totally. That's why it's critical to study these patterns, not just in finance, but across all interconnected systems. Once you understand the mechanics of escalation and decay, you start to see how fragile or resilient these systems can actually be.
All right, so now that we've unpacked interconnected systems and feedback loops can lead to cascading risks. But your published research went beyond this. You asked the question, does that kind of escalation also apply to fraud? You said it did. So, are we really saying fraud can cluster and spread just like earthquakes or financial contagions?
Absolutely. Fraud doesn't unfold in isolation, it clusters. Think about major SEC fraud investigations. One high-profile case breaks, and suddenly there's a wave of related probing across similar companies or sectors. It's not random, it's systemic. This clustering makes fraud both a financial risk and a self-exciting process, just like those earthquakes we were talking about earlier.
So, detecting one instance essentially increases the odds of uncovering others. But what's driving this clustering effect? Is it purely regulatory or something deeper?
It's both. When fraud gets exposed in, say, one firm, it highlights systemic vulnerabilities. Think accounting loopholes, weak governance, or market pressure to meet unrealistic profit margins. These weaknesses aren't isolated to one company. What's even more fascinating and scary is how fraud spreads like contagion. Rival firms may cut corners just to stay competitive. And when regulators and auditors apply more scrutiny, well, more skeletons come tumbling out.
And that's incredibly destabilizing. So, where do fraud swaps come into play? How do they work exactly? And while we're here, how big of a problem is fraud to, say, stock shareholders?
Okay, so the impact question is one I got a lot when I first spoke about this. The University of California at Berkeley and the University of Chicago published a paper based on data from auditing firms that picked up companies that were left auditorless after Arthur Andersen, the Big Five accounting firm, went bankrupt because of rampant fraud in its portfolio of companies. It was a rare chance for the remaining Big Four firms to dig into Arthur Andersen's client base and uncover how widespread the fraud really was.
And what did they find?
Turns out about 14.5% of companies commit fraud in any given year. And here's the kicker. On average, it costs investors 22% of the company's enterprise value.
Wow. So that means about 1 in 7 companies is committing a fraud. And for each of those companies, it affects more than 1/5 of enterprise value. That's unbelievable.
It is.
Okay, now tell us about the fraud swap, because this just took on a much larger scale than I thought.
The fraud swap is a financial derivative that I patented years ago and spoke about at the annual CFA conference in 2019. It was also the backbone of the hedge fund I ran. Think of fraud as the financial cousin of credit default swaps, but tailored to fraud risk.
So they're financial derivatives?
Yep. Derivatives that allow investors to hedge against the financial fallout from fraud hitting their portfolios. Here's the mechanics. Buyers pay premiums to protect against fraud-related losses, while sellers take on the risk in return for those premiums. When fraud is uncovered in the insured portfolio, the swap triggers payouts based on predefined conditions.
And these conditions, are they specific to cases like SEC rulings, or can they be broader?
It can be both. For now, conditions might include regulatory findings, material earnings restatements, or freezes in withdrawals for custodial accounts. But the power lies in modeling the probability and clustering of fraud mathematically, anchoring it in something like a Hawkes process.
Okay. So that means you believe that parameters like baseline fraud rates, self-excitation, and decay rates allow for customized and dynamic pricing.
I do.
Interesting. But developing these models must be challenging. How do you ensure that the fraud swap actually aligns with real-world risk in a reliable way?
Great point. The precision comes from leveraging historical fraud data, building accurate stochastic models, and continuously calibrating them. It's not perfect, of course. Financial systems are messy. But By tying fraud swaps to robust mathematical frameworks, we're essentially turning something intangible into something measurable and actionable. That's a huge leap forward for risk management, and some great mathematicians have modeled portfolio risk so elegantly that applying a framework to a new kind of risk, like fraud, is quite possible, in a formal, codified way.
So it's fair to say we're talking about more than just mitigating losses here. Fraud swaps could incentivize better practices across sectors, right?
Yep. Good governance and transparency could directly lower the cost of fraud protection, making it more attractive for investors and also pressuring firms to clean up their acts. It's a strategic tool, not just a parachute.
And that's really the point you made earlier, right? It's not just about spotting shocks, it's about managing and containing them. I can see how this would reshape how we think about systemic risks.
Right? And that's the key here. Fraud, like other risks, isn't going anywhere. The question is how we manage it. With tools like fraud swaps, we're not just reacting to disasters, we're creating a proactive financial ecosystem that adapts to and even preempts risk clustering.
We've covered a lot of ground on fraud swaps, from their mechanics to their potential to reshape risk management in traditional finance. But here's a thought. How might they apply to something as unregulated and volatile as the cryptocurrency space? Specifically, could they address fraud risks in Bitcoin custody?
Oh, absolutely. Cryptocurrency and Bitcoin in particular is kind of like the Wild West of finance right now. When you're holding assets with third-party custodians, like exchanges or wallet services, you're vulnerable. FTX was a stark reminder of that. A fraud swap for Bitcoin custody could act as a much-needed safety net, hedging against risks like mismanagement or, worse, outright theft.
Interesting. So it's not just about protecting the individual investor, it's really about addressing a systemic gap in trust, right?
You nailed it. Trust is the Achilles heel of the crypto ecosystem.
Even though it is supposed to work in a trustless world.
Well, the reality is that when custodians fail, whether through fraud or negligence, it shakes confidence across the board. A fraud swap doesn't just reimburse losses, it imposes accountability. It also incentivizes custodians to be more transparent and disciplined, knowing that their fraud premiums will be higher if they appear risky.
Right, but with crypto being so volatile already, wouldn't adding a structured risk instrument like this complicate things further? What about scalability?
Great question, as always. You're right. Volatility adds complexity. But that's where the math shines. By modeling fraud probabilities through Hawk's frameworks, we can quantify fraud risk even in something as turbulent as crypto.
Now, scaling this to a decentralized market does require collaboration between exchanges and maybe even involvement from insurers or regulators.
It does, but here's the kicker. The economic discipline it imposes could stabilize crypto markets over the long term.
Stabilize and protect seems like a win-win, but what about regulatory concerns? The crypto market is still, let's say, figuring itself out.
Totally. Regulation is a double-edged sword here. Essential for widespread adoption, but tricky within decentralized systems. Fraud swaps could dovetail with emerging regulatory frameworks. They might even encourage standardized reporting from custodians.
If you think about it, exchanges that comply with fraud modeling standards would attract lower premiums, making them more appealing to institutional investors. Now, that's profound, a financial incentive to encourage good behavior. So, in a way, these swaps could push the industry toward maturity. Any ethical considerations we should factor in here?
Definitely. There's always the risk of bad actors gaming the system, artificially inflating risks to unjustly trigger payouts, for instance. Plus, we need transparency about who's assuming these risks. Are they sophisticated enough to handle them? Like any powerful tool, fraud swaps need guardrails to prevent misuse. But if done right, they could genuinely transform crypto into a safer space for everyone.
It's fascinating. Fraud swaps, at their core, seem like more than just an insurance mechanism. They could enforce accountability and even reshape perceptions about financial resilience in decentralized systems. That's no small feat.
Exactly. And it circles back to what we've been saying. Understanding and managing risk isn't just about avoiding shocks. It's about building systems that can adapt, contain, and recover. Whether it's credit contagion or Bitcoin fraud, the tools are there. We just have to use them wisely.
Ophir, this has been eye-opening, seriously. And to everyone listening, thanks for coming along on this ride. There's so much more to dig into, so stay tuned.
On that note, we'll see you next time. Remember, the future of risk management starts with reimagining the possibilities. Thank you for joining us on CML Podcast. Take care, everyone.